Welcome to another earnings call for Dolla Financial Services. Today we'll be discussing the Q1 2026 results for Dolla Financial. I am Renee McDonald, the Investor Relations Lead at Learn Grow Invest, and I will be your moderator for today. And with me is the Dolla team. Before we go into the discussions today, please help me in welcoming David Henriquez, who will be opening in prayer for the team.
Morning, everyone. All right. Let us pray. Heavenly Father, thank you for bringing us together today. We ask for your wisdom, clarity, understanding as we conduct this earnings call. Guide our discussions, help us to make sound decisions, allow us to work together with respect and unity. Bless the work of our hands and let today's earnings call be productive and meaningful. In your name we pray. Amen.
Amen. Thank you so much, David. We'll see you again a little later. And now I would like you to help me in welcoming Kenroy Kerr to the platform, the Group CEO for Dollar Financial Services, who will be taking you through the agenda today.
All right.
Welcome, Kenroy.
Hi, Renee. Good morning, and as usual, thank you for facilitating us for quarterly earnings call. It's always a pleasure to be on this platform to share our results with our shareholders, and of course to take and respond to any questions or concerns that they may have. All right, so thank you, thank you. So good morning again, everyone, and thank you for joining our Q1 2026 earnings call. Overall, we are very encouraged as management by the company's performance for Q1. While our operating environment remains challenging in certain areas, particularly following the passing of Hurricane Melissa, and as well as the broader economic pressures that we're seeing in the wider environment in which we operate, Dollar has remained disciplined, resilient, I'd say, and focused on our long-term growth. So today I will walk you through our financial performance, the quality of our loan portfolio, as well as some strategic initiatives, as well as outlook for the remainder of 2026. Today we're also joined by David Henriquez, who did our prayer earlier, who will take us through some insight as to what's happening in one of our key subsidiaries, Ultra Financier. And we also have Traveen McKenzie, who will take us through in detail the financial numbers for our Q1 performance. So from a high level, Q1 was a strong quarter operationally. As I've said earlier, profitability improved significantly relative to 2025. Expenses were materially reduced, as well as the liquidity for the company strengthened significantly. And of course, the loan portfolio continued to grow in a disciplined manner. Importantly, I'd say we achieved this goal or these results while maintaining very strong secured lending position. And we continue to support, as we continue to support our customers through these challenging times, especially those who were impacted by Hurricane Melissa. So when we look at this slide, we're seeing where total income increased by 2% year over year to $513 million. And most of worthy note is the profit before tax, which increased by 55% year over year to $187 million, while the loan portfolio expanded 15% year over year to 4.9%. And one of the key takeaway from this quarter is actually the fact that we were significantly more efficient in Q1 2026 than we were in 2025, looking at a efficiency ratio at 39%. And this really reflects the company, it really reflects the impact of tighter cost controls, as well as some operational restructuring that we continuously do, and a more disciplined approach to growing our loan portfolio. In terms of the portfolio strategy and our sector exposure, so one of the strengths of Dollar remains with the strategy that we have for the business loan, for the company focusing on a business loan model. and focusing on models that are productive, that are asset backed, and these are sectors that continue to show a lot of growth in terms of the economy. We're seeing where 90% of the loan portfolio remains business related, and this is and lending to entrepreneurs as well as small and medium type enterprises. And we continue to see that the continued focus on this area of the business has helped us significantly when it comes to cost control, as well as the overall provisions that we make for the business on a quarterly or on a yearly basis. In terms of the portfolio sector and the sector positioning, we continue to focus on high impact asset-backed sectors with the company. We look at asset-backed sectors with the company secured loan model. And with this, we're seeing where the portfolio reflects a purposeful expansion in the transportation and logistics segments. I believe this is on the other slide. So in terms of the transportation and logistics segment, this now represents a 47% of the loan portfolio, up from 36% in the prior year. And this increase was driven by a deliberate strategy that we pushed to deepen our exposure in a sector that we consider to be integral to economic activity and is well aligned to the company's secured loan lending model. You'd have seen where I believe last year we had loans in the construction sector, for example, real estate and construction, outweighing the majority of the portfolio, and now we have changed a little bit in terms of how we made that shift, because in the transportation sector, what you also find is that your average loan ticket size has gone down dramatically relative to like the construction sector, and that ultimately reduces the risk and spread the risk across significantly more accounts than having a few large accounts in some of the other sectors that we'd be focusing on. All right, so we did see some increase in our non-performing loan during quarter one, moving from 13% in 2025 Q1 to 15%. However, we believe that this is largely driven by the temporary pressures I spoke about in terms of the Hurricane Melissa, the impact that Hurricane Melissa has had on a good segment of our customer base. As you know, Dolla really started operation in the western end of the country, and subsequent to the hurricane, would have put out a notification to shareholders of what we think the impact on the portfolio will be in light of the damage or the severe damage that took place in those areas. And we did say that we expect to see somewhere of about a 4 to 5% impact in terms of accounts and write-offs that we would have to do. The reality is that we continue to see significant improvement in these areas. However, there are some customers who continue to struggle in terms of keeping up with their payment and would have resulted in somewhat of a default. We have designed measures to continue to assist these customers, and one of the more important things is that a large portion of these facilities remain secured by real estate, by motor vehicle, and we are putting in place strategies to assist these customers. We don't want the first step to be to intensify repossession and liquidation when customers are facing challenging times. So we're working with these clients, and we do anticipate that we should see some improvement as these customers continue to recover from the impact of the hurricane. So we have been intensifying our collections effort, looking at some structured repayment arrangement, as well as a continued focus on the lending, the secured lending, and our risk mitigation to ensure that we bring as closely as possible the NPL in line with our internal target. But management do believe that this portfolio and this risk still remains manageable despite a more challenging operating environment. And the ECL, which also is a really good indicator of the loan portfolio, quality would have remained steady. I would say over last quarter, we saw a slight increase from about 3.8 or 3.9% to 4.8%. But this again is really in line with the fact that we're operating in a slightly more challenging environment. In addition to the fact that we'd have made some changes to the methodologies that are used to calculate the ECL to account for what's happening in the economy. So some of the ratios would have increased, and that will just naturally increase the ECL or the provisions that we make, in addition to the overall increase in the size of the loan portfolio. All right, so at this time, I will pause and hand over to David, who will take us through, just give you some insight into what's happening at Ultra Financier.
All right, thanks, Kenroy. Thank you to everyone who has logged on this morning for this earnings call. So for the first quarter of 2026, we have increased our loan book to 1.7 billion. And we are holding about 3.6 billion in collateral. Q1 has been a very strong quarter for us, especially coming out of some challenging times in 2025, which, is no secret to the public. Kenroy mentioned the challenging environment and that it has been. But we have tightened up a lot of our processes, and it has been a very, very strong quarter for us. And we are pretty proud of that. We've deployed over 400 million in funds for the first quarter. So we are looking to continue that momentum throughout 2026 so that we can really produce some good profits, which will benefit our shareholders at the end of the year. We always continue to strengthen our adjudication and securities processes. We know that staying dynamic in the market is one of the most important things. And as times become more challenging, and they will get more challenging, that we stay ahead of it, or we're able to maintain the quality of our loan book, the quality of the services that we can provide for our customers, and the quality of returns that we can provide for our shareholders. We look to increase our loan book to about 2 billion by the end of the year. And based on our trajectory, we do see that being quite possible. We are aiming to get our NPL back down to 10%. As we've mentioned on many earnings calls before this, is that the NPL at Ultra will fluctuate with larger swings than maybe the dollar portfolio, based on the size of some of our individual loans. As you can imagine, with a loan book of 1.7 billion, if a $100 million loan slips into a non-performing state, it can give us big swings. But we are cognizant of this, and we continue to stay on top of it. Our NPL will also fluctuate as we look to liquidate certain assets. We know that in Jamaica, selling a property can take 6 to 8 to 9 months. And therefore, we will have these slight delays, which will then affect our NPL for short periods of time. But we are always looking to liquidate assets that have loans that are sitting in a non-performing state. And we always look to do so as quickly as possible and as prudently, because at the end of the day, we're not out to gyp anybody. We want our customers to get as much return as they can on their properties and their assets, as we look to clear whatever arrears that they are. As I said, we continue to improve our processes. We want our customers to be happy, but we also want our customers to understand the environment in which we are lending. And, as much as we would love to lend you $35 million overnight, there are processes that we must go through. There are certain securities that need to be in place before we can hand over $35 million. If it was your money being invested in Dolla and Ultra, you wouldn't want us to be deploying it to any and anybody overnight. So, we want everybody to just be aware that obviously these things take time, but we always are cognizant of the time it takes, and we do want to help our customers as quickly as possible. And this can't be done without a strong team. So, we continue to strengthen our team, not necessarily in numbers, but in quality and in training. And so our team continues to move forward with our customers at the forefront of our minds to make this process better for them continually. So I will pause here and I will hand over to Trev, who will take us through the numbers.
Thanks, David, and good morning, everyone. Thank you for taking the time out this morning to just take a listen to, what we've been up to. It's been a while since we've been on Learn, Grow, Invest, and we're really happy to be back. Now, Ken Roy did an amazing job of really taking you through the highlights of the financials of the company for Q1 2026. But notable for last quarter really would have been our profit before tax, which increased by 55% year over year, up to $187 million for the 3-month period. We also had a significant reduction in operating expenses, down 28% to $202 million. And of course, our cash and cash equivalents stood at $802 million, which went up significantly when compared to our Q1 2025 numbers. Now let's roll forward. So we spoke about our KPIs. Kenora really did a great deep dive into, what would have driven our profits for the year, or ECL, NPL, and efficiency. So we can move forward into the meat of the matter, which would be our balance sheet. Now, as mentioned before, our cash and cash equivalents saw a very large jump up to $802 million. And of course, the public would have seen where we closed out on our $1.5 billion bond that was arranged by Mayberry in the first week of January. So the proceeds from that would have been sitting as cash as at the end of March 2026. Come Q2, we will see changes in this, of course, because we would have paid out our dividend payment in April, which was $150 million. And of course, we have some loans coming in, some larger loans that would be paid out during the Q2 period. So we will see changes in this going through the rest of the year. We also saw an increase of 15% in our loan portfolio year over year. So now we're up to $4.9 billion. We were hoping for more, and we're used to seeing more in terms of a growth in the loan portfolio. But what we have been doing last year and into Q1, we have been seeing organic growth. The 12-month period last year, we were lending based on what we were collecting, and we still saw healthy growth in the loan portfolio, and that transcended down into Q1 as well. And we also had a little bit of a downtick after Hurricane Melissa, and we are now recovering. So we're hoping that in Q2, and we're working towards this in Q2, where we can see more of a healthier year-over-year growth in terms of the loan portfolio. Loans payable increased also by 19%, and this is of course due to the additional bond that closed earlier this year. And of course, we're seeing a very large growth in other payables and accruals, and this is simply due to the dividend declaration of $150 million that would have been sitting in that financial statement line item as at the end of the period. The payment was made in April, so we expect that the other payables and accruals line will normalize come Q2 and beyond. We also saw healthy movements in shareholders' equity, moving from $1.2 billion to $1.7 billion, which is a healthy 44% growth. And this is, of course, due to the increase in the comprehensive income for the period, which of course transcended from the retained earnings, which grew by 72% year over year. Now, in terms of our income and our profits, as mentioned before, we are very happy to report that we would have seen a 55% growth in our profit before tax, which stood at $187 million as at the end of the 3-month period. We are looking at total income, which essentially was flat of $513 million as at the end of the period. Now, as mentioned before, we were seeing organic growth in 2025, and then in the latter part of 2025 we did experience Hurricane Melissa, and because of that some of our top performers in Savannah Lamar, in Montego Bay and in Mandeville were not able to do the volume that they were accustomed to doing. So because of that we would have seen some impact on total income, but nevertheless we were still able to do a 2% increase year over year, and we expect that going into Q2, 3, and Q4, we should be seeing more of an increase, because the recovery of those branches, we're seeing the recovery in the numbers of those branches, and that will transcend into the rest of the year. We did see a reduction in net interest income, and this is solely due to the interest expense, the additional interest expense that we would have incurred for the 3-month period. As you know, the bond raise would have been closed in January, so we would have had a strong 3-month additional interest expense that would have accrued throughout that period for that $1.5 billion bond that we did not have last year. Notable on the P&L was the significant reduction also in operating expenses. Now, as we recall, last year, March 2025, we would have seen where we would have written off quite a bit of funds due to the fraudulent activity that took place throughout the financial sector last year. And in our Q1 numbers is where we would have started to recognize that, hey, 1 or 2 of our loans would have been impacted. Fast forward to 2026, we have no such events where we would need to write off any fraudulent loans. So we're seeing where our expenses would have normalized in this quarter. And we're expecting that going out through the rest of the year, we will continue to see normal expenses, because at this time we have no inclination of any additional fraud or any additional write-offs or major write-offs that will be taking place throughout the year. All in all, we were able to achieve an earnings per share of 7 cents, which increased by 40% year over year, which we're quite happy with and very happy to report this morning. Now, quickly on the cash, we would have ended the period, as mentioned before, with $802 million in terms of cash, which is a significant increase year over year. And the majority of this, of course, is coming from the bond raise, the proceeds from the bond that we would have received. We also noticed that our collections has been increasing. We're seeing where we have experienced healthy collections from January, especially after recovery of Hurricane Melissa, where collections would have experienced a downtick in October, November, and December. January has seen healthier collections, and we're seeing where that also transcends in the cash flow from operations as well. And at this time, I'd like to hand back to our CEO, Ken Royker, to wrap up and tell us just a little bit more about what the outlook looks like for the company.
Thanks much, Travina. Thanks as always. So in terms of 2020, the remainder of 2026, I'd say that we remain quite optimistic about the remainder of the year, and we do anticipate to see further growth as we go through quarter 2, quarter 3 of 2026. One of the major focus that we'll be looking at, as we have already begun Q2, but before the end of Q2, we do anticipate some increased focus on our brand visibility and customer engagement. We'll be launching shortly. I know that my marketing team is working on this, but we'll be launching some new initiatives that are targeted at micro, small, and medium-sized enterprises in the transport sector, and just some business that are looking to grow, to recover. So we'll be having something that we'll be focusing on from Q2 that we believe will help strengthen our market presence and deepen our relationship with our customers. We'll also be focusing on strengthening our continued strengthening of our collections. As Travine said, we've seen a lot of stability where we're better able to predict in terms of the funds that are coming in. So we have seen some significant improvement in this area of the business. We've made some restructure, some major restructure in Q1 as well, and I believe that we're seeing some we're seeing we're seeing the results of those restructure that we did earlier in the year. So we'll continue to focus on just maintaining and preserving that liquidity for the business. As maybe I'm preempting questions that may be coming, but I know that we have a strong cash position, but at the same time, we will be very, very focused on how we grow and ensure that it's being done in a disciplined way. So it's not a rush to lend out to just be disbursing every single dollar that we have as we've done in the past, but it's just to ensure that we're lending in a disciplined way, in a way that will ensure sustainability for the business, that we can predict the income, that we can still see level or steady growth in the income over the next several quarters. But at the same time, we're focusing on the quality. So when we do lend, these are funds that we can, in fact, collect without any major problems. We're also for some time in the very near future, we should be wrapping up our Evolve transaction. I know that you've seen some press release about our agreement or acquisition or proposed acquisition of a loan portfolio, and we are waiting on some authorization at this point in time, but we're actually advancing in that transaction, and we do anticipate that in very short order we should have some more information for our shareholders where that is concerned. And of course, we will continue to focus on cost optimization and just the continuing to be as efficient as possible in this business. We have again seen where, based on how we have lent over the last several quarters, we can predict there's a lot of it's better for us to predict where income will be. I can literally look at my files and know what income will level off in Q2, and we'll just work on that to see how best we can improve, as well as maintaining the expenses or reducing the expenses as much as we can. But we believe that the company is now operating from a much stronger position than we were at this point in 2025, and we are in a more disciplined position than a year ago, and we do anticipate further growth, steady growth, as we go through the remaining quarters of 2026 period. I'll just stop here and welcome back Renee for leading this segment, the next segment.
All right, thank you so much, Kenroy. And with that, I will add David and Trevine back to the platform as well as we go right into the questions and answers. So congrats to the team, Dolla and Ultra, for another successful quarter, and of course for being prudent in your management of cost, etc., even considering the devastation of Hurricane Melissa. So it is good to have you back, and we are looking forward to hearing your answers to the questions. So let's get started. The first question is from Garfield, and I think he's asking if interest rates will be going up, if that's an expectation. Is that Kenroy or Trevine?
I mean, I can take that one. So if Garfield is asking in relation to our rates that we transition to our customers, for the most part, we have not increased our interest rate for the last maybe over the last year, and that is because at the end of the day, we're more focused on diversifying, growing our customer base. The more we grow and the more customers we have and the more money we lend, and the more we lend in a disciplined way, we do believe that we can offset that increase in whatever interest we would charge our customers. And at the end of the day, especially in this kind of environment, we do not want to be just moving with what's happening in the market in terms of interest rate and levying that burden on our customer, which puts them in a position where it becomes more burdensome to make their payments. So at this point in time, not to say that we won't need to make adjustments to our rate based on how the business is performing, but at this point in time, we're more focused on discipline and finding ways to lend more prudently so that we can recover and reduce our overall risk of default or overall exposure to the client, so that we don't have to do the write-off, which means that that goes directly to income.
Got you. Thank you for that. A community question from the LGI community. Can you describe how the recovery has been for the Western parishes impacted by Hurricane Melissa? Has it been to your expectations? And I suspect that this is the recovery in lending on that side of the island.
So I can speak of it from two folds. So on the lending side and on the collection side. Obviously, we saw significant the hurricane impacted our business in that area significantly in the last 2 to 3 months of the financial year. We have seen significant improvement in Q1 in terms of collections on our recovery effort, and we have seen while we're not at the level that we were pre-Hurricane Melissa, the demand for our lending products still remains very healthy, very strong. We have just been, as I said before, as we've been saying on this call, that we've just been a lot more prudent in terms of our adjudication. So even though we really want to assist as much as we can in terms of the new loan disbursements, we're more focused on helping our existing customers to recover, helping them, finding ways that we can help them to afford their existing loans. And for the demand that we have really been focused on ensuring that when we do disburse these facilities, that we're able to recover. So there has been significant improvement, not where we were pre the hurricane, but we're seeing gradual improvement every day in those areas.
All right, thank you for that. And that is good to hear because it speaks to solid recovery for the island, right?
Right.
And the next question is the NPL increase as a result? Is the NPL increase a result of the portfolio or the impact of the hurricane? Okay. A result of the size of the portfolio or of the impact of the hurricane?
So if I may take that one as well, I'd say that it has to do with the hurricane. As I've said in my presentation earlier, about a week after the hurricane, we did an assessment as we typically do for any events that we think might impact the business, and most importantly, we actually disclosed the findings of that assessment, and in that we found that our at risk for portfolio, we were seeing about a 4 to 5% impact in terms of loans that may go into default. It hasn't quite materialized to 5%, but that is a significant contributor because we do have customers who had good repayment history. They paid their loans on time and they were just not in a position to make payments. While we try our best to facilitate whatever restructure moratoriums that we could, we still find that we have some of them in default, and we're actually trying to help those customers. So maybe, so there's no doubt that has contributed to the rise in the NPL. We do have one or two other accounts, especially maybe one or two on the ultra side, that we're trying to liquidate these properties. And as David mentioned in his presentation, one significant account can swing the NPL by 2 or 3%, depending on how long we take to actually dispose of that asset. So it's kind of twofold, but the hurricane does play an impact in that.
Right. Okay, thank you for that, Kenroy. The next community question: what's the path to growth for Dolla Financial?
All right, so I'll take that one. So basically, what we have been doing, we have been ensuring that the organic growth wheel is turning. And we saw that last year, whereby we weren't raising funds, we were simply lending based on collections, and it has been great because we see where the resilience of the business and the lending was able to recover from Melissa and from the fraudulent activity that took place. So that's one. And then, of course, you would have seen in the media whereby we are exploring acquiring the loan portfolio of Evolve. And that is another avenue of growth that Dolla is currently pursuing, in addition to looking at other companies that we could possibly do a similar arrangement with. So we're working both sides of the wheel, and that's what we've been up to.
All right, thank you for that. And I think this follows right onto that. Is there anything more that you are able to share about that Evolve opportunity at this time? That's essentially that question.
Yeah, just say that we have the transaction has have moved to the execution phase, and the main thing now is to get the no objection from our regulator. So both parties have applied for submitted applications regarding the transaction, and we are pretty much waiting on regulatory approval at this point in time.
All right, thank you, Kenroy. So David is asking, based on what was shared, net loans was up 6.81 million in the quarter, meaning similar disbursement versus inflows. Did the group taper off loan disbursements due to risk management, or was there another factor?
All right, so I believe I mentioned this again in a prior question regarding the western end of the island. So we have seen when we do our assessment, the disbursement for Q1 2025 was pretty much in line with what we disbursed in Q1 2026. So year over year, the disbursements were pretty much flat. It's not a result of a lack of demand, but it's just about us assessing the risk a little more carefully, especially in light of what's been happening in the wider macroeconomic environment, not just to do with the hurricane, but we're looking at some new elements that can have that persons are facing a lot of pressure when it comes to prices and their ability to actually make repayments. So having taken those factors into consideration, we've made adjustments to some of our policies that may make it a little bit it may make it a little bit more prudent for the business in terms of assessing these applications and disbursing the loan. It's not a lack of demand, but just that we are doing it in a more prudent manner to ensure that at the end of the day, the business remains viable, it remains sustainable, and we are able to collect on those facilities once we do the disbursements.
All right, so more on the risk management side then.
Pretty much.
Thank you. All right, so this question, do you expect to be using AI to aid in the processing or evaluating of loans? We've spoken in the past about tools that were under development for Dolla, and you did mention, I think the last time we discussed it, you did mention that it takes some time to build, go through the whole development cycle and to test and train and all of that. So in that process, are you planning to include AI?
All right, so I'll take this one. Just to be frank, we have been looking at different ways that we can improve efficiency in the business and how we can use technology to improve. A lot of our focus has been on work in the back end of the business, because the reality is that AI tools, while contributing to greater efficiency in a lot of businesses, the type of loans that we do, that's where we have a difficulty. So Dolla is not, the AI tool is very ideal for microlending institutions or other institutions that focuses a lot on very easy, predictable, unsecured facilities. So you just need a job letter, pay slip, the system will flag those things and then give an output. Because we focus so heavily on business loans for one, which it's every business is different. And we also focus a lot on secured lending. When we do acquire, or we look at the costs that are involved in acquiring a solution, or a digital solution that is customer facing, we have to weigh the cost of the system versus the amount of customers that it will help. At the end of the day, we're not focused on expanding our unsecured loan portfolio. We're still focused on helping businesses doing secured loans. And that's where we have a difficulty having a system that fits a solution. It still requires physical presence, physical persons going to the business, doing their inspection, learning about that unique business. And a lot of times we can't find a AI solution that will actually give us that result. And that is why we have had the conversation in the past. We are still looking at it, but we are more focused on improving our back-end processes versus those at the customer-facing end. Because again, the nature of the loans that we do, you have to ask the question if it makes sense to invest in something that with such a heavy cost for such low return.
Yes, and just to add to that as well, AI for reviewing documents, especially in light of the fraudulent activity that's taking place, yes. But as Kenroy mentioned, the loans that Dolla writes, it does take a lot of common sensing and a lot of personalization in terms of reviewing that the AI won't necessarily be able to assist with. So,
Understood. Thank you. What is your current dividend policy, and is there a target dividend yield?
So our current dividend policy is at 50%. And I believe we published this in all of our publications at Neuro Report and all that. In terms of our target dividend yield, at this time we're at about 2%. And based on where the business is, 2 to 5% is a healthy dividend yield. So we are aiming to stay in that range for now until things change.
All right, thank you. David is asking, or states first, the group ended the quarter with 802 million in cash. Is there an expectation to ramp up lending in the coming quarters subject to risk constraints?
That's correct, and I'd have to touch on that in my outlook that we'll be launching. We're actually launching something that we do believe will drive disbursements in Q2, Q3 of this year, but obviously subject to risk.
All
the risk
right.
constraints, right?
Yes, yes. David again is asking for the CFO. So this is for you, Trev. What percentage of the group's loan book is currently in moratorium, and what income was not collected related to Hurricane Melissa?
All right, so circling back to when Hurricane Melissa took place, we would have published that about 4 to 5% of our loan portfolio would have been assessed as possibly impacted by the hurricane. We would have issued the moratorium to customers maybe around December, if I remember correctly. And customers have been trickling in terms of the moratoriums. Some customers still didn't have electricity and all that to even be aware of what's happening. So we're seeing we're about 1 to 2% of the loan portfolio is currently at a moratorium. And the moratorium for each customer might be different. Some persons were offered a 1 to 2 month, some 3 months based on what they're able to repay. So it's not a straight line effect right across the board. So in terms of the income that was not collected, at this point, we're not seeing where interest receivable has increased significantly because of the moratoriums and because of Hurricane Melissa. We are seeing possibly where $50 to $100 million possibly was impacted, but not a significant jump in interest receivable because of this, the moratorium that were issued.
Okay, that's commendable. Will Ultra be seeking additional funding to ramp up lending and go above that $2 billion target?
No, we're not looking for any additional funding at the moment. Based on properties that we have to liquidate, other big accounts that are set to close out, we should have a nice consistent flow of cash coming in to be able to online and continue to grow our loan book steadily till the end of the year.
Awesome. For Trevine, has Dolla finished the wind up for the Guyana business?
So David, at this time, the answer is no. We are looking to complete same by the end of this year. We would have completed all the necessary accounting as at the end of December, wound up the books, the loan portfolio has been zeroed out, and all those activities have taken place. We have appointed a liquidator, But there's still some processes in Guyana that needs to be cleared out before we can fully wind up the business. And based on those timelines, it's looking like Q4 2026.
Okay, thank you. Michael is asking, are there any updates on the recovery process on the fraudulent issue? It would have been mentioned before in terms of the issue itself. Is there anything on the recovery process to share?
So we're still following those accounts. Obviously they were significant write-offs for 2025. While I can't give a definitive update on each of the cases, we have taken action where appropriate, and guided by the authority, where we have filed suits against persons that we can at this point in time. And in terms of recovery, I believe it has been minimal, to be quite frank. During 2025, I believe we were able to recover about $4.5 million thereabout. But that went directly to the bottom line, and we're still in pursuit of recovery of any amount of funds we can, as best as we can. So at this point in time, we're just continuing the effort, and we are hoping that something will materialize during this financial year, that we can, as I've said earlier, we can just, anything we recover, it's automatically added back to our profit line.
Understood. Do you have any new locations in mind?
There might be something coming. Don't want to say much on that. Might be.
Okay, all right. Take note, guys. He's not saying much on it. Will Dolla be seeking additional funding in the year to support inorganic growth via acquisitions and supporting ongoing loan demand? That's what I'm doing.
To support inorganic growth via acquisitions, that we're not at liberty to say at the moment. We are waiting on the Evolve transaction to wrap up so we can do the necessary publications. To support ongoing loan demand, the short answer is no. We just closed our bond maybe about 90 days ago. So to support loan demand, no, we're still in receipt of some of those funds from the last bond. And that will take us throughout the year based on the bond proceeds and our collections efforts.
All right. So with that response, I'm going to jump down to this question from Jamaica Politics. Can you explain the thought process behind buying Evolve and the win for shareholders?
If I may take this one, and as Straveen said, we will have some more disclosures once we're able to for the Evolve transaction. But I can say that the transaction will not materially impact our short-term earnings. What it does is that it expands our customer base, it enhances the loan portfolio diversification, and it creates an opportunity for us to cross-sell and to improve the services that we do offer. So over time, we do expect that this acquisition will drive stronger growth in terms of our cash flow, in terms of increased market share, and just more sustainable value for the shareholder. Once the transaction is at a stage where we have completely executed all that we need, and we have received the necessary approvals, then we will in fact disclose more relating to that transaction. But there are quite a few opportunities as it relates to that portfolio.
All right, thank you. We have two more questions to go and just a few minutes left. So the next question from David is for you, Kenroy. If you strip out the hurricanes NPL, what is the current NPL for Dolla? Also, what is Dolla's preferred NPL target? So without the impact of the hurricane, what would the NPL be, and what is your NPL target?
David, if we, in terms of our preferred target, for ourselves, we always set the bar is always really high for us, and we're always aiming to achieve an NPL of 10% or lower. If we strip out those loans that were impacted by Hurricane Melissa, we'd probably be looking at about 12% NPL at this point in time. So I'd say the hurricane impact is about 3% currently on the NPL.
Okay, thank you for that. And the final question in the chat is from Jamaica Politics TV, and it says, is Dollar considering utilizing the increase in market cap to 750 million?
The short answer on that is not in the near future. There's a cost associated with this kind of activity, and we believe at this time the return on utilizing the additional market cap won't be as significant to the shareholders or the business at this time. So the short answer is no.
All right, thank you so much for that, Trevine. I do want to share John Phillips' comment. He said, remarkable, clearly on the right path. And that is always good to hear from those who are watching. So thank you so much for being here again, Dollar team. Thank you for always providing the comprehensive responses and being willing to talk with your shareholders. Just before we go, I do want to give Kenra an opportunity, just in case there's somebody watching who doesn't know who Dollar is and what you do and who you're for, to have just 2 minutes to say who is Dollar and who are you for.
Okay. All right. Thank you, Renee. So I mean, Dolla Financial has been I'd say it's now a household name in Jamaica. A lot of people will a lot of people who have difficulty accessing credit through the traditional loan platforms and are unable, traditional banks, commercial banks, and are unable to access capital, access credit to grow their business, to take care of their personal expenses. That is our focus. So we're focused in helping the unbanked, the underbanked, and to help businesses specifically take the next step in their path of growth. So you will find that Dollar focuses significantly on business loans, micro, small, medium-sized entities. So whether you are somebody on the roadside selling jerk chicken and you need some assistance to buy some stock to improve your business, to take your business from a jerk pan on the roadside to a plaza, to a shop on a plaza somewhere, we are there to help you take that next step forward. I always look at it as Dollar planting, helping to mold that one tree until it becomes a forest, pretty much. We have been around for some time. There are significant improvement that we have made to the lives of our customers, and not just through lending, but beyond the financial performance. We've also continued to support our communities. We've always looked at how we can help our customers to improve, to grow. When I look at, for example, the hurricane in the last quarter of 2025, and just how we've moved to help our customers, the relief that we've put in place, whether it be through moratoriums, through fee waivers, or just helping our customers to restructure and to build back, to help them to grow. It's just tremendous, the level of support that we actually offer for our customers. And that continues to be the pillar on which we operate. At the end of the day, it's all about the customers. Once we know that once we are there for our customers, the business will grow, and we continue to design products, enhance our products, improve our processes to ensure that at the end of the day, the customer is better off. That will result in improved growth for the customer. And I mean, at the end of the day, for our investors, for our shareholders, I know that the main reason that you take a risk, you buy the stock of Dollar, is for good return. And this is a company that has been growing and growing significantly over the last several years. For last year, for example, we grew profit by approximately 30%. And as you can see in Q1 of 2026, we have grown profit by over 55% relative to the last quarter of the first quarter of 2025. And that continues to be our focus for our shareholders to add value. That's why we look at the acquisition opportunities. We look at different ways that we can add value to our customers, which ultimately adds value to the business and adds value to our shareholders. Thank you. Thank you, Renee.
All right. Thank you so much, Kenroy. And thank you to our audience for the time and your participation today. We will see you in the next earnings call.